Reserve Bank of New Zealand is New Zealand's central bank who manages monetary policy, maintains price stability and promotes the maintenance of a sound and effective financial system. The Reserve Bank has recently proposed an initiative to increase the required amount of capital held by commercial banks and for the owners of the banks to invest more of their own money for equity. This change will require large banks to increase their capital ratios to 16% and smaller banks to increase their capital ratios to 14 to 15%. This presentation will be arguing in favour for the Reserve Bank's decision to change banks' capital requirements and will outline the pros and cons of this decision to reduce the risk of bank failures. One of the benefits of increased capital requirements is that the decision will make depositors' savings safer. In New Zealand, there is no depositors' insurance, which means if a bank was to fail, the bank's depositors will not be paid out for their savings, and the government may have to use taxpayers' money to bail out the bank. When the Reserve Bank's higher capital requirements, the banks will be better protected from losses and large shocks in the economy, which means that the depositors' savings will be better protected.
High capital requirement able to correct this perverse incentive of shifting more risk to the shareholders, since the more capital, the more risk falls on the shareholders. As the provider of the risk-bearing capital, also there will be a smaller government subsidy of reckless behavior. Moreover, the increase in capital requirement will largely eliminate the significant capital advantage of the Big Four banks currently in New Zealand. As higher capital buffer is required for those large banks, this might force them to divest their business in New Zealand and then invest in other markets, since have higher return on equity, which is beneficial for New Zealand's own bank, such as Kiwi banks.
RBNZ increases capital to limit the risk around bank failure. However, secondary impacts may arise. Investing the capital necessary to build spare capacity comes at a cost. First, by having higher capital requirements, it lowers the bank returns on equity and bank profitability. It's likely that banks will attempt to expand the profit pool to restore returns of equity by increasing mortgages and lending rates for borrowers. Second, the lower end returns of equity could be offset by lower saving costs, which is lower the deposit rates for savers. With more capital equity and potentially less lending due to increase in lending interest rates, there will be less needs for the bank to raise debt funding. Given deposits can be expensive funding, for banks will have less needs to compete for funding, and hence deposit rates may fall. In addition to the reduction in supply, the banks will be safer entities and bond investors may require less compensations for their risks.
In conclusion, the Reserve Bank's capital review will reduce the risk of bank failure in the financial crisis, as well as protect depositors in New Zealand in the absence of a formal depositor insurance. The shifting of risk from depositors to shareholders will also reduce the risk of morally hazardous behavior. High capital requirements for bigger banks will offset some of the advantages the large banks have and allow some smaller banks to be more competitive in the market. A possible downside would be that banks will have their profitability cut, and they may try to pass this on to consumers by increasing the rates they offer on loans or decreasing the interest on deposits. While profitability is one of the indicators in evaluating a bank's value, we also need to consider its stability and ability to absorb shocks in the economy. We believe that the cost of the change will be offset by the benefits of a safer banking system, and this should be reflected in a bank's value.